Here's everything you need to know about becoming an income partner at Kirkland Ellis in 2026. And while it's a huge career milestone, your finances are going to look a lot different than they did as an associate. From compensation to benefits to retirement plan contributions and taxes, there are a lot of changes that will materially change your cash flow. And this is what I'm going to cover in this video. Hey guys, I'm Joel, your Big Law Money Guide. I'm a certified financial planner, and this is the type of content that I cover in this channel. So follow along if you want to make the most of your big law income. All right, let's start at the top with compensation. Being the largest firm in the world with over $8 billion in annual revenue, it's no surprise that Kirkland follows the cravat scale for compensation. But their partnership track looks a little bit different than most firms, with associates eligible for partnership only after their 6 years, as opposed to maybe 8th or 9th year for most other firms. This means that first-year income partners at Kirkland can expect to make the same amount as a 7th-year associate on the cravat scale, which you can see here on the screen. So in 2026, the base compensation for a 7th-year associate is $420,000. So that's what income partners at Kirkland can expect to make in their first year of partnership. So that translates into a bi-monthly draw of $17,500 that you get on the 15th and the last day of the month. We'll talk about what is deducted from that draw in just a little bit. And if you hit your billable hour requirement, of course, you're entitled to a year-end bonus, which is $115,000, the same as, again, as a 7th-year associate on the cravat scale. And just like some of its AmLaw 100 law firm peers, Kirkland dishes out special bonuses from time to time. Like in 2025, they handed out $25,000 bonuses to their income partners. The only difference between a 7th-year associate on the cravat scale and a first-year income partner at Kirkland is that Kirkland helps out their first-year income partners by giving them an extra stipend on top of their base compensation to help offset some of the changes that we'll talk about. In 2026, that special stipend is $18,750, which is split equally over the 24 draws throughout the year. So all in, you can expect an income of around $550,000. So on paper, the compensation looks very similar to a 7th-year associate on this cravat scale. But where things start to change is after that money hits the system. Let's start with the changes in benefits. At many AmLaw 100 law firms, new partners are suddenly responsible for the full cost of their benefits. And this can be a major jump, especially if you're covering your spouse and your kids. The good news is that Kirkland still subsidizes most benefits like medical, dental, and vision. The caveat to this is that you must enroll in the HSA plan. So you can expect the same cost that you were paying as an associate. That said, there are a few benefits that are no longer available to income partners. For example, the dependent care FSA that many young parents utilize to cover the cost of daycare is no longer available to income partners. Same thing with the medical flexible spending account. You are now also responsible for purchasing a $2 million life insurance policy on the firm's group plan, as well as a $5 million excess liability policy or umbrella, again, on the firm's group plan. So these can add up to your cost benefits. And lastly, you are now responsible to pay the premiums on your group long-term disability policy. So the result is that you can expect to pay $3,000 more per year in benefits than you were as an associate. New income partners are also required to contribute a portion of their year-end bonus toward the defined contribution 401k plan. Let me explain what this means. In a defined contribution or 401k plan, there are two sides: the employee contribution, which you're used to as an associate, but also the employer side. The combined total of the two contributions is called the 415C limit. And in 2026, the 415C limit is $72,000 for folks under the age of 50. That 415C limit is also split into two limits. The employee can only contribute up to $24,500. This is the limit that you're probably used to hitting when you were an associate. The remainder amount of the $72,000 or the $47,500 is called the employer profit sharing contribution. And most firms, when you make partner, you're mandated, you're obligated to contribute the full profit sharing contribution side or the employer side of $47,500. Now, the employee side is voluntary, and it always will be voluntary. But most firms will mandate their new partners to contribute the full $47,500 in the first year they make partner. Kirkland does it a little bit differently. They have a step-in process into this number. In your first year as an income partner, Kirkland requires that you contribute only 25% of the employer side of the plan, as opposed to the full amount. So in 2026, what that means is that your required contribution from your bonus is $11,875, or 25% of $47,500. In year 2 and 3, that required amount jumps to 50% of the employer limit, which again in 2026 is equal to $23,750, or half of $47,500. And then in year 4 and beyond, you're required to contribute the full amount of the employer side of the plan. Again, that's $47,500. Now keep in mind that the 415C limit goes up every year by usually about $2,000. So these numbers that I just gave you will stick up a little bit every year. And keep in mind, this is on top of your employee contributions that you were used to making as an associate. And those will be deducted from your bi-monthly draws. All right, so that covers benefits. Next up, we'll talk taxes, which is another major change. As an income partner, even though you don't share in the profits of the firm yet, you're treated as an owner of the firm. And from a tax standpoint, you're now a self-employed individual, just like if you own that coffee shop around the corner from your office. Here's what that means. First, taxes are no longer withheld from your paycheck. So it's now your responsibility to remit those taxes to the IRS on your behalf. So what hits your bank account is actually not all yours. A good portion of it belongs to the IRS. That's why it's important to set aside the specific amount from each paycheck or each draw to pay your taxes at the end of the quarter. And those quarters look a little bit different than regular calendar quarters. First quarter is from January through March, and the first payment is due by April 15th. The second quarter is only 2 months, April and May, and the payment is due by June 15th. The third quarter is from June through the end of August, so 3 months, and the payment is due by September 15th. And then lastly, the fourth quarter is the last 4 months of the year, September, October, November, December, and the last payment is due by January 15th of the following year. Also, it's important to note that payments are due throughout the year. So you can't just wait till the end of the year and write a large check for your entire tax liability for the year. You must pay them as you earn income throughout the year. Otherwise, you could be subject to underpayment penalties. So that's why it's really important that you speak with an accountant so they can let you know how much to pay each quarter to avoid underpayment penalties. Another change is now that you're a self-employed individual, you're also subject to the self-employment tax, which is the equivalent of the Social Security and Medicare tax. As an associate, you're responsible for half of that tax, or 7.65%. As a partner, you're responsible for both sides of the tax, as the employee and the employer, for a total of 15.3%. The good news is not all of your income is subject to the self-employment tax. In 2026, only the first $184,500 earned are subject to the Social Security component of the self-employment tax. So it's a little bit of a misconception that your entire income is subject to the full 15.3%. Also, you get to deduct half of the self-employment tax on your personal tax return. So you get some of it back through a tax deduction. The third thing that can change from a tax standpoint is state taxes. As an owner of the firm, you're now responsible for your share of the tax liability in every state where Kirkland earns a profit. And that's true even if you live in a state that doesn't levy an income tax, like Texas or Florida. For example, if you have a partner living in Dallas, Texas, they may be responsible for their share of the tax liability that is generated in the state of Illinois or in the state of New York. And those state taxes are withheld from your draw each month. So the self-employment tax and state taxes alone can increase the tax burden of a partner pretty significantly. And that's why Kirkland implemented the special stipend that I mentioned earlier to try to offset some of these changes to your tax situation. Also, the good news is that Kirkland has created a partnership with the CPA firm Koppel and Foreman, and they basically subsidize some of the costs of the tax return preparation and have a very streamlined process where they upload your K-1 and make it pretty easy on you. All right, so to wrap up, when you combine compensation, benefits, retirement plan contributions, and taxes, the jump to income partner can feel very different than what people expect. And that's why it's really important to make a plan ahead of these changes so you're not caught off guard when you need to cut a $30,000 check to the IRS in the first quarter. And if you feel overwhelmed and you need help navigating these changes, this is the type of things I help my clients with every day. So schedule a free introduction call in the link in the description below. Thanks for watching.